Welcome to episode 5 of our Citi Market Watch series. We do hope that you are enjoying and finding these updates useful and meaningful. Audrey, I'm not swearing, and please don't take umbrage, but what four-letter word are we talking about today?
Very funny, son. I can't pronounce it, but it is FOMC.
You mean the Federal Open Market Committee. I suspect many would love to be a fly on the wall at the FOMC. Audrey, who or what is the FOMC and why are their decisions important?
The FOMC refers to the 12-member committee of the US Federal Reserve or central bank, which decides on the US monetary policy, in particular, the extent to which it buys and sells US debt, controlling the supply of money or liquidity, and also the price of money, the discount rate often referred to as the Fed funds rate. This influences how banks and institutions will deposit money with the Fed as opposed to lending it out. The FOMC's decisions are important because the US is the largest economy in the world. US debt is deemed as benchmark or risk-free, to which other debt or bonds are priced to. And also the US dollar remains the reserve currency to the world. And hence, depending on the US interest rates, holding US dollars can be costly or beneficial relative to other currencies.
Thanks, Audrey. And just for context, last year, as the pandemic engulfed the world and forced a global lockdown, global GDP collapsed, as did markets, to depths equivalent to previous recessions going back to World War II. But the pace of the collapse was incredible. The S&P 500 index fell 35% in barely 30 days through March last year. And yet, by the end of 2020, the S&P 500 was up 16%. To a very large extent, the healthy functioning and rebound to date of the economy and markets can be attributable to the decisions of the FOMC in particular and other key central banks. Audrey, the Fed's balance sheet has expanded from $4 to $8 trillion and is buying 120 billion US dollars of bonds every month. Can you elaborate on what this means and shed some light on the mechanics of the FOMC?
Easy peasy, son. An $8 trillion balance sheet and buying 120 billion US dollar every month, these are no small numbers. The short answer is this is what is referred to as quantitative easing, which is in fact unconventional monetary policy. In normal times, it would simply be sufficient to adjust the Fed funds rate, and this price would be sufficient to leverage banks and the banking system to adjust the amount of liquidity or money circulating in the economy. It's been a fairly gradual process, but especially post-2008, as developed economies have matured, the deceleration in growth has coincided with aging demographics and the additional disinflationary forces of global trade and technology. This has all conspired to reduce monetary leverage in the system and hence the need for quantitative easing.
Or I guess one way to objectively think about it is, if a younger, more vibrant economy saw $1 get exchanged more frequently across everyone, an older economy where that dollar is passing from one person to another less quickly or frequently, it needs more money in circulation to keep the value of everything on par. Okay, thanks, Audrey. Let's fast forward a bit. We talked about inflation risks in episode 2, and now as inflation has risen, the market is getting more concerned about the reality that the FOMC will begin to taper or buy less bonds. That is, reducing that 120 billion per month rate of purchase with the view that the FOMC will also look to raise interest rates. What did the FOMC say in its recent meeting?
Well, previously, when asked, Fed Chair Jerome Powell said that the FOMC wasn't even thinking about raising rates. But after its June meeting, this statement has progressed to the FOMC is now talking about tapering and tightening. The committee's expectations are reflected on the FOMC's dot plot, and it shows that the FOMC expects 2 25 basis point rate hikes by the end of 2023. Reading in between the lines, Citi analysts expect a tapering announcement in September, whereby the Fed will reduce its monthly bond purchases by 15 billion per month, beginning in December. Underlying all this, the Fed is forecasting core PCE inflation to be 3% in 2021, 2.1% through 2022 and 2023. So, Sun, how should investors think about the second half?
In a US context, investors should be cautious. In addition to tapering, there will be continued debate around the persistence of inflation, the impact of taxation, and also margin pressures and earnings. These headwinds aside, let me remind investors earnings growth for 2021 has been revised up globally to 39% from 26%. This will be followed on with 20% earnings growth in 2022. And as we continue to see rotation across sectors and regions globally, in addition to the continued acceleration of Citi's unstoppable trends, asset allocation and portfolio construction is now more acute and important than ever before. Look for those dislocated opportunities across emerging markets, from ASEAN to LATAM. Search for income across emerging market sovereigns to quality equity dividend yield. And look for more agnostic, uncorrelated growth across healthcare, renewables, and disruptive technologies. If you're staying within fixed income, Citi remains underweight, but we favor short duration strategies and high yield.
And don't forget another key highlight from Citi's second half outlook, the growing bifurcation across China and US or G2 polarization. Whilst this tension is initially unnerving, the competition between China and US, especially on economically sensitive areas like semiconductors, will see a significant realignment of supply chains, and Citi analysts sees much of ASEAN and parts of EM as beneficiaries. Sun, pivoting back, what are the implications for the US dollar with a more hawkish FOMC?
Well, at least over the short term, talking about raising rates removes downside tail risk for the US dollar, which has weakened significantly in the last year. But as we just highlighted, we are seeing a lot of rotation as investors find value and opportunities everywhere. So even with respect to the US dollar, we are seeing more weakness across its developed market peers, like the Japanese yen, whilst broadly, Asian and emerging market currencies continue to hold as growth, yield, and trends remain attractive or are growing in appeal. Over the longer term, for perspective, the US dollar remains 10% overvalued on a trade-weighted basis. It remains plagued by large, persistent, and growing US federal and current account deficits and rising expectations from stronger growth across Asia and emerging markets. Audrey, this is the overview on the FOMC and what to expect.
Thanks, Sun. The FOMC impact on markets is important. As the US and global economies reopen, rebound, and reflate, it is just healthy for interest rates to also rise and normalize. This process will create volatility across markets and asset classes, but it's a good problem. It's broadly a rising tide. But you do need to take time to pick the better or best boat. So thank you for tuning in to this episode of Citi Market Watch. Please contact your Citigold or Citigold Private Client Relationship Manager for more opportunities.